Well, I established my own self-managed super fund when I was just 29 years old with a balance of $67,000. 11 years on, my super is now worth more than 10 times that amount, so I think it's probably fair to say it was a good decision for me. Some years, of course, are better than others. My financial reports show that in the 2015 to 16 financial year, my time-weighted return was 53%. A few retail or industry funds could compete with that, I'd have to say. But it's interesting that one of the most topical questions people ask about establishing an SMSF is, what is a suitable balance? Now, the industry in general tends to base the answer on what the value of the super fund is compared to the cost or the percentage cost of running it, and benchmarking it against other super vehicles. An acceptable level generally, it's widely agreed, starts between $200,000 but generally $250,000. However, in my experience, I see many people establish self-managed super funds with low balances purely because they want to take control of their super and they think they can outperform the market. And statistics show that, interestingly, most SMSFs do. In my earlier days, I used to use an investment advisor to help me select stocks, and I had a fairly blue chip portfolio. But over time, as my confidence grew, I started making selections myself. And my best performers have been generally through initial public offerings or IPOs for companies that are well known to me as a consumer. My most significant performer is a stock called Xero Limited. As an accounting practice, we were one of the first adapters of the new cloud-based accounting software. So when Xero first launched in Australia, I acquired a large volume of shares at just over $5. I understood and liked the business model. As a user, I found the software amazing. Today, the shares are currently valued at about $25. The Class Super software that we use to deliver the Super Guardian SMSF service listed at $1 in December 2015. Now again, I strongly believed in the software and the technology and the people behind it, so I acquired as many shares in the IPO as I could. And today it's now trading at $2.90, which is a pretty handy gain over an 18-month period. But my philosophy with both stocks is that I believe in their future growth and potential, so I'm very much going to set and forget. As far as my investment strategy goes, my current issue is diversification. My portfolio is predominantly shares and cash, so I am currently looking at using gearing in my SMSF to acquire an investment property. I do strongly believe in a balanced portfolio. I find running my SMSF simple. The benefit of using an administration service is that you can bin all the share registry paperwork when it comes in, because the administrator is receiving electronic data feeds in the background. I don't have to worry about share registry updates or keeping copies of all of the source documents for audits. I can focus solely on making investment decisions. One of the key benefits of being a trustee of my own fund is that I'm engaged with how my portfolio performs, because the information is easy to access. For example, being able to view it in an instant on my mobile phone. But if I'm heavily involved with my investments, it doesn't mean I ignore the need for some specialist advice. So in particular, I do rely on my administrator to hold my hand when it comes to ensuring my SMSF is compliant. So essentially what this all means is that I'm actively involved in my retirement savings strategy, in stark contrast to many of my friends who hardly know which fund they are in, let alone what investments it holds. Given that, it's little wonder that SMSFs continue to have strong appeal in the market, and we're continuing to see the growth.